commercialization, and we run a bunch of innovation and entrepreneurship programs. We run the basement programs down here on our first floor, and then on the fourth floor, you may have been up there, that's our entrepreneurship center. We have a Horizon Accelerator, a Maverick XR VR studio. We run national security innovation programs, and we also have a podcast studio. So we do a little bit of everything. One of the things that we love to do is we love to bring VCs like Eric and Brian in a regular series called Meet the VC. We do either Innovation at the Edge, which is a panel discussion, or we bring in VCs to talk directly to our innovation and entrepreneurship community. Because as you know, the most important thing about being an innovator is actually not just your own thoughts, but how you communicate those thoughts to the outside world and how you get people to back you in those ideas. So we believe that it's really important you speak or you hear directly from folks who are on the ground doing the work and have real world experience. So, and I know that Eric started with a couple questions. I'm gonna ask you some questions too, just real quick. How many of you are undergraduate students here at UC San Diego? Raise your hand. Nice, okay, we got a huge innovation community here. How many of you are graduate students? Great, and faculty? Any staff here? Awesome, a little bit of everything. So this is great. We're so glad you're here. We are live streaming this event, so make sure that our speakers use the microphones. At the end of their sort of like question and interview, sort of casual interview, there's gonna be a Q&A with the audience. I'm just gonna ask to make sure that the audience questions also get into the microphone as well. So yeah, that'd be great. And I think at this point, I'm going to turn this over now to Eric Otterson from Silicon Valley Bank, and then you can introduce Brian if you like.
So before I introduce Brian, I want to finish the last question, which was, of you that are starting companies, there's two questions to it. One is, how many are in that technology space? Okay, great. And then how many of you would classify yourself on the life sciences side? Okay, great. I'll try to make sure that we cover both sides, because it is a little bit different about how you approach the venture capital market from the tech or the life sciences side. Now, the lucky part is that Brian and I know each other for a really long time, so we're very close friends. And we welcome you all, 25 years? Yeah, we met when I was 5. We welcome you all to be friends. So even though we're doing a presentation up here, fully acceptable. Brian will interrupt me, as you'll see. I'll interrupt him. We've known each other long enough that that's fine. But it's also okay for you, if you hear something, this is for you. Like, we're here for you to answer questions, for you to help break down the barriers to understanding the networking and connecting into the venture world. So please do feel free to interrupt. And then give us a moment to repeat your questions so we get that captured. Now, Brian, Ankona Ventures, Ankona Capital, I did it again, yeah. But the great thing about Brian is San Diego was a little bit of a sleepy town. And you'll see these are all tech companies. So Brian is a tech investor. We'll get into the companies that Ankona looks into. But San Diego, one of the things that we still fight with is we do a poor job of promoting the companies that are here in San Diego and highlighting the awesome ecosystem that we have. And I'm going to throw a couple other companies out there just so you can know about them. But Drata is a very fast-growing company. Seismic, super fast-growing company. You have some older school companies that have been here for a while and still very strong, like Kyriba. And then on the space tech side, of course, we have Viasat. People all forget that ServiceNow is a San Diego company. There are at least 500 employees here. It's just that when they went public, they moved to the management team came out of the Bay Area. So a couple classic things about San Diego that people will say is that, wow, like, it's really difficult to raise money in San Diego, one. And then two, it's hard to find the right type of employees in San Diego. That is what I heard back in 2000. My answer to you all, and Brian, you can disagree with me, is it's not hard to raise money in San Diego. It's hard to get a good company rolling and get that customer connection so that you get the interest of other investors. Now, I bring that up because part of what Brian has done here in San Diego, living here, he saw these other great companies that have grown up, and I would put Sochi in that class of companies, Cordial, and then we have Zingle was a successful exit, and Walla and Lawmatics are both still successful companies. So he came in and saw this opportunity that wasn't being exposed in the Bay Area, perhaps, which I think probably made it attractive from a valuation perspective. So number one, you can, with a good company, get financed in San Diego. Number two, the other great thing is all those companies I mentioned to you, and there's another 10 I could go through, have been here long enough that they have brought in employees who have been with them from, say, 5 million in revenue, which is kind of that early stage where you're running around figuring out how to get those sales, up to maybe 30 million in revenue, where you're starting to get middle management into the company. And that's important because they are training the workforce for tomorrow. So the intellectual property of employees in San Diego has grown since the 2000s. Now, the third problem is that I think, this is my personal opinion, not that of the bank, is that the San Diego entrepreneurs needed to get to the stage that they valued the employees enough to pay them a salary that was better than some of the other cities. And that was because we've always been a bootstrap town. And so you have to, as a CEO, you have to think, okay, am I at that stage that I should put a little bit more money into those employees to get that experienced employee? And now they don't have to move to San Diego. It's perfectly fine to be wherever you are. But there are benefits to being in the ecosystem. So they are starting to do that too. We see more people moving to San Diego, especially after COVID showed that it was such a great place. But a lot of the folks that moved here have stayed here. So that's just some preamble. And Brian, why don't you come up and tell us a little bit about Ankona Capital, or a lot about it.
So I do hope you guys ask a lot of questions, because we can talk about everything, all kinds of stuff, but I want to make sure it's relevant for you. So interrupt and ask questions. The one thing you missed about San Diego, so my lens is software, and broadly AI, and now increasingly what I'd call physical AI, but still sort of software business models. We got life science, and San Diego has a huge hard tech community. I started my San Diego investment career 25 years ago when we first met, investing in semiconductor companies, Entropic Communications, RF Magic, Planet ATE. It was all hard tech, it was all semis. And we have that back today with a lot of really innovative drone technology companies, all kinds of exciting hard tech stuff in San Diego too. You missed that.
I did, and I'm going to add to it because it's such a good point, in that these, again, the intellectual property, the people that did the semiconductor companies, San Diego and Orange County, stayed here. And so, for example, it's public knowledge, but if you haven't looked at it, there's a company called Unconventional. They raised $500 million, I think last October. They don't have a product yet, and they're building a chip. So when you build a chip, yeah, it's...
and that was over. 15 years ago, that was over. You couldn't invest in chip companies anymore.
Naveen Rao. And what's amazing is that he's a successful entrepreneur, but he's found, he believes with his team that they found a scientific means of producing an NVIDIA-type chip that has much lower power consumption. So
that is super cool.
It is super cool. And I forgot, remember the slides? We get to talk about those too. So excuse me, I'm going to bring up some data here for you all to enjoy. And yeah, how about your glasses? Yeah, sorry. Yeah, I forgot. You don't need to read this. I'll tell you about it. You can go access this on the SVB website. It's the State of the Market Q1 2006 State of the Market report. And I'm only going to show 2 slides. But what I wanted to give you a little bit of what is happening in the fundraising space, because that's going to guide the direction that you all go about, and you can know what the market is like. The nice thing about this data is that it's based on companies that are Silicon Valley Bank clients, and we only bank venture-backed companies. So that's tech and life sciences. So it's clean, if you will, from other types of manufacturing services or small product companies, mom and pop type shops. The takeaway here is what's happened with like AI is, if you look in the last couple of years here, and investment itself is, it suggests, well, what you'll see is the blue is important, the light blue. Those companies that were under 100 million in valuation, you know, those were kind of the bread and butter of the investment world. Then, boom, we've got companies that are over 500 million. So the largest deals are getting the most investment. Now, Brian can tell you what he thinks about why people do that and why the proportion of smaller companies is getting less money. Maybe some of that is because the venture capitalists need to put more money. They're getting huge funds, And whether they're managing $5 million or $50 million or $100 million, it's almost the same amount of work. So I think that you can say that there is a drive to put more money behind a deal. And then down here, you'll see that many of the VCs' behavior is starting to become more like a private equity firm, meaning they're joining the companies when they're larger, so there's less risk. There's already that product market fit has been made, and the risk of early share. So they, Y Combinator, of course, is fantastic. The early stage, they're going to be even an angel investor, but you get others like Lightspeed starting to move towards the larger and lower share of early stage companies. Why? I don't know the answer. I think it's a good debate that we can have partially here. Some of it may be, we have a little bit of the Wild West with AI. It's accelerated development so quickly that you either have to have an AI type product or certainly be using AI in your workforce, so you're driving down the cost of the company, or perhaps it's helping you pursue your sales team is being more effective with AI.
Okay, I want to interrupt for a minute there.
Yes.
So the implication of this that I don't like is that the smaller deals are not happening, and what we are seeing is just a tremendous amount of capital going to these supernova bets. There's going to be a lot of really expensive lessons learned there by a lot of investors, but if you want to build your own LLM and you need the infrastructure, you've got to make these massive bets. And we saw the same thing in the dot-com era, where there were 6 search engines, each of which raised billions of dollars, and a couple survived. We're going to see the same thing here. So that's distorting. The takeaway from this should not be that if you're not raising a mega round, nobody's interested in you. And we're seeing on the ground exactly the opposite, especially starting Q1 and Q2. The AI dividend is really starting to show, and companies need less money. So there's sort of a barbell market right now where you have these supernova plays that everybody's getting behind. They might be very binary in their outcomes, but you gotta have a bet if you're the certain kind of fund in these spaces. And it doesn't matter, you gotta be in them. That is a venture bet, it's a gamble. At the core, at the other side of the market, what we're seeing is round sizes are much smaller, where we might have done a Series B that was $30 or $40 million 5 years ago. Today, those same companies are asking for 10 to 20. So there's a shift in the market, a barbell between these supernova companies that are raising massive amounts of money and your regular old school software companies that are reaping the dividend of AI efficiency, and they're just raising less. And that market is still very healthy. There's a little bit of chaos, in Q1 when people were wondering about what was going to happen, but that market is still very, very healthy. So most companies need less money. So I would expect to see smaller rounds raised at most companies, just not a function of what the market is saying, but a function of what those companies actually need.
I'm seeing the same. So the bank, the way our relationship works is the venture capitalists will typically come into a company, put equity into that company, and if you think about it, the amount of money that you're raising is really about 30 months on what's what we see typically, because you've got to spend that money quickly on your sales, engineering, and marketing to get your revenue from, if you're at, say, 2 million, get it to the 10 million. If you're at 10 million, you got to get to 30 million. And you typically do that within about 30 months. So the bank will come on the heels of the equity and put a little bit extra debt in there. That gives you maybe 36 months. It gives you a couple more months, and the benefit to the company is that with the higher revenue rate, because they're growing 20, 23% per month, with that higher revenue rate, you're going to get a better valuation at your next round. But I'm seeing the same thing. So where I can show correlation is we either see these massive deals, and I'm doing loan proposals the size of which I've never done. Usually I'd be really happy with a $2 million to a $5 million loan. In the past 4 years, I've had 3 $90 million, and 2 weeks ago, I have one that's $150 million. So wow, that's huge. But at the same time, I have a few that are in that 2 to 3 million space, because it's that middle that you're right. The middle's a little bit different. Not as many companies raising, saying they got somewhere like, say, 30 million, 50 million. They're either getting 10 to 12, or they're getting very large amounts.
And I want to say one other thing that I object to here, because this VC path, this is not the right path for a lot of people. And you sort of get this TechCrunch, Silicon Valley treadmill. And it's not real. Like, a lot of this is not real. If I was starting a company today, I would be avoiding venture capital if I could. And I probably could if I was building a software company. It's just I remember I had a founder here, told me I hate the freaking VCs because they just want to pour all this gas on my company and light it on fire. And if it takes off, that's fantastic. They got a rocket ship, they got their billion-dollar exit. But if my company burns to the ground, they just move to the next thing. And there's truth in that. Like, VC incentives are not necessarily aligned with founder incentives. And you got to know what you're getting into. These companies raising all this money, they've got big expectations. And if it doesn't work, you're hosed. And so this, like, the focus on VC, the focus on these big mega rounds, it's unhealthy, I think, in a lot of ways.
It's funny, he used another analogy when he told me that story, I think 10 years ago. It's like being Wile E. Coyote, and the VC is Acme that ties the Acme rocket to your back. They don't really care if you hit the mountain or if you clear it. They just want you to do it quickly. Question?
So it kind of hits my question from earlier. And with advance of AI right now, I feel like I can build my own company with like $500 a month. And I wonder, like, what is the benefit of raising money externally? Like, what's the value the angel investor or seed investor?
None. Don't do it. Build your
Hang on,
company.
I have to repeat the question.
Sorry.
So the question was, given the benefits of AI and the efficiency that it drives for building your company, why go out and get VC money?
Don't do it.
I disagree.
Don't do it.
It depends on the company. It depends on your growth. So if there are many ways, you're absolutely right, that you can grow a company. They used to call it bootstrapping. I won't call it that because it's not a negative. It's a lot of these folks are actually getting a good company and growing organically, very quickly. Organically meaning without venture capital. But if you're, the question I would raise, and I see this with a lot of our potential clients. I had a large space company that raised a large amount of money, and as I'm talking to the CFO, he says to me, it's the same question that you have, but a little bit larger scale. He says to me, we think we're going to grow this company, and by next year, we're going to be cash flow positive. And you're going to love to disagree with me on this, but what I said to him, that sounds great. You got your forecast, and if you think about it, if you hit your forecast, you've been killing it. So do you want to stay at that same rate, or do you wish you had more money to go even further, or are you going to flatline it and make it a lifestyle business? Like, what are you going to do? You're going to get bought? I think having more money is better than having less.
I would have agreed with you more a year ago, and I would have been less definitive in what I advised. I'd still probably have said the same thing. But today with AI, it is just completely different. I mean, your ability to scale a business, not just on the product side, but on the business side, is changing so radically that I don't think a lot of companies today will hit the bootstrapping plateau that they did before. So I would go, I'll change what I said. I'll compromise with you. Go as long as you can without raising external money. If you think you're going to have angel investors that are going to significantly help you in some important strategic way or something, maybe if you find the right angel investor. Most of them won't. Most institutional seed and Series A investors won't help you get to product market fit. They won't do a lot of the things that you've got to do as a founder to get to the next level. If you reach the point where you say, you know what, this is working, I need to add some sales and marketing, I need to invest $1 million to get them on board and to make them productive, after which time they ought to be covering their own nut. They ought to be paying for themselves. Then you make that decision. But I'd go as long as you can. You as the founder will know more about what it takes to build your business and what to do than any investor you're going to bring on.
True that.
I have this question for Brian. I was wondering how have your thesis then have changed along the years in now AI they change so rapidly, right? So myself, my name is Ken. I work in Atlas Capital. We are Fund 2 now, facilitating over $150 billion from family office in Asia Pacific.
Very cool. Yeah.
Fund like yourself in America. So I'm wondering how have your thesis evolved so you can stay competitive against all the funds?
Oh my gosh, this is such a good question. So the question is, how has our thesis evolved to stay competitive with other funds? So we had a thesis early on that there was a bit of a gap in the market. We are investing in companies that might otherwise be venture backed, but we are a growth equity we have a growth equity mindset, which means we've always been more aligned, we think, with founders, with incremental growth, efficient growth, maintaining exit optionality, which means, you know, if you get to the point where you can sell your business for $200 million and you still own 30% of it, it's a pretty good outcome. If you raise too much money, you're not selling for 200 million and you got to go for $1 billion, and you know, bad things happen. It's very hard to do that. So initially the thesis was we're solving a gap in the market with founder-friendly capital for companies that would otherwise be at sort of a venture stage, 5, 10 million of revenue, too early for traditional growth equity. What's changing now is, first of all, I'll say this, I have never had more fun or been more excited about what I do every day than I am right now. Like, I'm so incredibly excited every day about what I'm doing, what the portfolio is doing, the opportunities we're looking at, our own AI transformation at Ankona. I'm vibe coding stuff. Like, it's the coolest thing. I'm building stuff. This is the coolest time. So we should talk more about AI and how that impacts software. But I'll tell you, our thesis, and I will say this with probably more conviction than I should, but I think it's plausibly correct, is that we're potentially on the cusp of a software investment supercycle. Efficiency always expands demand, always. Jevons paradox, 1856, Jevons noticed that when steam engines became more efficient, demand for coal went up, which is a counterintuitive result. But the fact was that more efficient steam engines expanded the places where steam engines could add value, and demand for coal therefore went up. We've seen this over 70 years in software. It is 96% more efficient today to produce a unit of software than it was 70 years ago. And every step function increase in software efficiency has increased demand and employment and everything else. So we think we're on the cusp of an AI investment-driven supercycle, so we are fired up. We can go more into that. There's a lot of other components of that, but obviously all our investors are asking about that right now. So we've had to spend a lot of time developing our own theory about what's happening. And for us personally, we're a small fund. We will raise a $200 million fund next. And our ability to write a smaller check, we can write a check as small as $5 million, fits in perfectly to what founders need because they're not looking for those huge checks anymore. So it's evolving and changing. We're super excited, and I think that our model fits even better in the next few years than it did in the last 5 or 6.
Is there any vertical that you focus on these days versus like 2 years ago?
Well, we stay away from, we're not playing in those yellow rounds. We don't do that. So we still do a lot of vertical software, which and we think a lot about moats and what constitutes a moat for AI. And to us, a moat is just a measure of how much time you have as a founder to transition to AI-first operations. We can talk more about what that means. So we do a lot of vertical software, systems of record that are transitioning to systems of action, changing the product to be something that advises users on a per-seat model to something that runs the business priced on results or usage. We stay away from data center, crypto, developer tools, so software applications that you could explain pretty easily to somebody. Like some of the ones that you saw in there. Lawmatics is an intake and CRM solution for law firms. You know, easy to understand.
It's interesting you said vertical, and I think that's a key word now. Yeah. That if we look at the history of software, so you know, back in 2005, 2006, you had Salesforce.com. Their logo was software with a cross sign through it, no software. And yet, you know, all back then, and even up until pretty recently, all software was about, you know, a company that grew and then increased its features because they're trying to meet more features and get up the chain from small, medium businesses up to the enterprise business. Then it becomes so bloated and big, people don't know how to use it, it's too expensive, you need a team inside to put it together, so somebody else comes up. But I think, and this is for you to comment on, is we see companies like in the CRM space I know pretty well, but you have companies like Lawmatic, but the ones that were doing a platform type play, so trying to be everything for every business. ClickUp, Monday, there's a number of them, even Salesforce today. Like, you're competing with Salesforce, but you're competing because with AI, first of all, with AI, you can't be a platform anymore. There's too many individual businesses that you have to go after and be good for. And one of your friends in the room here is going to go after that niche and kill it because they're going to meet exactly what that niche needs. So, yeah, it's go vertical. The other thing I think I'll add to that is that if you go vertical, the next thing that's most important as a CEO is knowing your customer very well, also the product people, of course, but in your early stage, because your moat is that knowledge that the customer is using your specific product. It's kind of the same model as the guys that got bloated, but you're just bloating within your industry. And so if you continually engage with your clients, I was at a client event last night for a San Diego company. They're bringing their winning clients in. They talk to each other. His engineers and product folks are hearing, one client talks about, I'm using it this way, which is completely different than they thought, but they can expose that to the other clients, and that's free revenue, right? They're not doing anything for the product. And they have another feature that people can use. And then at the event at your house, I had Doug Winter, who was speaking to an early stage entrepreneur, and he too was talking about how you've got to stay on top of the top percentage of your clients. CEO, he stayed on top of it, met with each of those larger clients, both because they like to have the name factor and the title factor, but also you've got to stay in the game strategically, and those are the most important clients that bring in the revenue, but you also get a good picture of how your product's being used and can work with the product team to keep guiding the future.
So Eric, is there any AI data mode that you believe in, but you think Brian will disagree?
Is there AI data model I believe in that I think data moat that I believe in that Brian would disagree?
Well, I'll just say, so we do look at what we think are moats, and we think now more about what's more likely to be impacted sooner rather than later. But the way that we look at moats is just a function of lead time before you got to complete the transition. So we don't think any company is safe. Every company's got to transform to what we call AI first operations, which is a function of the product. It's a function of the way the company works, and it's a function of the way the business model works. So all those things. So we've got companies with moats like you wouldn't believe. Like we do a lot of now physical AI investments. So we have an investment in a company called Orca. That's like Waymo for ships. So they mount a big camera pod on top of ships, and they do autonomous navigation and collision avoidance. They just updated their software to look for mines. Nobody's going to vibe code that, right? But they've got to transition to AI first operation. They got more time than a Monday has to do it. So any moat is just buys you time, but everybody's got to change.
And I think we agree, but I'll put it another way, is it's a running moat. Your moat's only as good as what you learned yesterday, right? Because I look at it this way. If you're talking to your customers, you're going to learn information that is not yet on the internet. The moment it's on the internet, all your competitors know it. So if you're adding a feature or you're going to start marketing it because you want people to know about it, but you better know about the next level, because once on the internet, everyone else can come in under you and try to copy what you're doing. Go ahead. Has branding become a disposable mode?
Moat.
Moat.
So if you believe that we're in a future with unbounded agents, I don't know, you've heard the distinction between bounded and unbounded, then brand doesn't matter in that future. So I would say that's certainly an eroding moat to the extent that you believe in this world of unbounded agents doing everything. We have a different view about how intelligence is likely to get into the enterprise. We think it will be mostly bounded agents, and that intelligence will get into enterprise accounts via the software, and that incumbents have the advantage there, because enterprises still need deterministic systems. They still need audits. They still need something that produces predictable results, not in a black box. So you still need this system of record until AI can solve that. So we think mostly bounded agents, but even the companies that have strong systems of record in our portfolio are moving to the point where they can transact agentically. So just exposing their solution the same way. I don't know if you saw Salesforce announced a headless version of what they've built, which just basically means that anything you want to do in Salesforce can be accessed via API, a command line interface, or agentically. The future is probably a hybrid, but I would think for sure brands don't matter as much. Now, brands build their reputation partially because of how well they understand and satisfy customer needs. That doesn't go away. So to the extent the brand was earned because they do a really good job satisfying customer needs, that doesn't evaporate. But in an unbounded agentic future, the brand itself doesn't probably mean much.
And I got it.
Really good. I like that question.
Yeah, it's a great question. I think I would say brands do matter. Or I'm trying to think of all these different examples of. If you look in the financial world, right? When we first came out with, say, a Betterment or a Wealthfront, right? You have these agentic, basically, investors for you. And in the very beginning, they grew very slowly because people weren't quite sure that the software worked the way it was supposed to work. And by the time it becomes, I think it's probably the cross the chasm, right? Crosses the chasm, then you get the Vanguards and the Fidelities buying or creating their own. Or another example might be like everything you buy at Costco, you have a confidence, A, that you can take it back, but B, they've kind of vetted that product. When you go onto Amazon, wow, it's a different game, right? Because Amazon doesn't guarantee that that's my product. Like they do try to brand it on there. And so my point would be anybody can make a software, but when you're making a purchase decision at an enterprise level, at some point these are going to get probably acquired maybe or brought together underneath a brand that has the reputation that the software works and doesn't have cyber issues because cybersecurity is going to become more and more important, that doesn't bleed your data. So I think it will have a play, but just
if your question is, are incumbents more vulnerable today? If
Well, it actually, well, there's a flip side to it. So if you guys are saying the VC money is chasing larger rounds, then that in itself is a moat because you need to scale.
Yeah, but that's not our game. So that's a completely different game. I mean, if you look at the world of private equity, there's venture capital, which ranges from seed and pre-seed to A, B, extension, growth. That's sort of that VC world. Growth equity is sort of more pragmatic. If you look at a venture capital portfolio, it's a power law model. You've heard that word before. You will have one company dominating returns, a handful that are producing meaningful returns, and a whole bunch that do nothing. And if you lose that top returner, you don't return capital, let alone make a good return. Growth equity is much more of a normal distribution. A lot of doubles and triples, very few strikeouts, couple home runs, completely different model. And private equity beyond us, doing buyout, is completely different, should have a much lower loss ratio. So loss ratio in venture capital early stage might be 65%. In growth equity, where I play, it's 11 or 12%. Buyout might be 8 or 9%. So it's just, they're completely different businesses.
Here, I'll add something, and you can disagree again, but just for fun.
You know I will.
If we look at this is where software was great, right? We had big software companies, they were getting huge valuations. Then we had COVID, and we had the Mishiznit period where they had valuations that were too high, and they had to spend the time to get their valuations, to get the revenue up to support the valuations. And we had AI going in there. So some of this may be companies that were big that have finally grown into their shoes.
Could be.
Yep.
I don't disagree with that one.
Yeah, I don't have the data to look at it right now, but I think that's playing some of it. The other, for sure, here at the very end, is space and defense. It's gone nuts, and that's completely different world. So that definitely skews this data. You had a question? Yeah.
Yes, with regards to brands don't matter that much, unless of course they have network effects. Would that be accurate?
Well, and that's a different moat. And by the way, when we're talking about brands, I'm talking specifically about B2B enterprise brands. You can make an argument that consumer brands matter less if you're going to have an agent doing your shopping for you. Consumer brands might be more durable than B2B enterprise brands. I don't know.
I'll still play for it because I don't know. I think about somebody we'll get there, in a large company like the big four accounting firms, right? You can't make a mistake buying from them. Somebody will eventually emerge. Who knows if like these vertical softwares get packaged as individual vertical softwares in a big company like Salesforce, for example. So they're no longer bloated because you really can do the modules. But
yeah, I don't think I'm not making the argument that it's absolute. It doesn't matter anymore. But directionally, I think you would have to bet that it matters less than it does today.
Yeah. Along with that, I guess I'll capitulate. And
Or
say,
it could matter less moving forward, depending on what you think about agentic commerce in the B2C world, and same thing in the B2B world.
and perhaps it's so much easier to build a software company now that your risk of failure, which is the problem with going someone who's not a brand, is lower. So, and a lot of your peers that are buying the software, in that group, also know about AI, so they're friendly towards that. So it may not matter.
So I just want to say that from my understanding, the brand is designed for the people awareness, right? But in the future, maybe my understanding may be not correct, but from my understanding that future the brand is for the AI agents. Yeah. So the software they develop, the software is easier to be used by the AI agent. Is a which has higher mode for the brand.
So previously, where brands were meant for the human beings to have an affinity, now because we will rely on AI to choose, you have to make the quote unquote brand easier for the AI to pick and understand.
Yeah, but I think we're just overemphasizing the brand thing. I mean, if you're a startup, you're competing against an incumbent. An incumbent has advantages. One of it might be brand, but as an insurgent trying to penetrate a new market, you're coming with a better, cheaper, faster product by 10x. You're always competing against an incumbent that has advantages, installed base, network, whatever you might say. Brand might be a component of that, but it's relatively small on the list of things that insurgent startups have to overcome in order to succeed against a big entrenched incumbent. And by the way, it's easier now to go after an entrenched incumbent. They are more vulnerable, but they're not sleeping. They're all doing the right things. So I would not underestimate the capacity of entrenched incumbents to survive the AI transition. Not all of them.
Okay, there was one, I thought over here. Yes, sir.
So there were a couple questions there. One, there ought to be a flood of new software companies because it is so easy to build a product. So how do you make a decision? And the other one is really, what is the future of software, and are companies like Intuit going to go away? Right? Did I get the two? On the first one, I have no idea, but my expectation is this Cambrian explosion of startups that we should be seeing. Most of them aren't going to be asking, they certainly won't be asking me for money. Some of them might be asking the early stage venture investors for money, but I think more and more of them are going to do what I suggested earlier. They're just going to build a company, and they're going to get the revenue with, and a founder last night told me he started a company with no employees that's doing $500,000 a month in revenue with 0 employees. I think more and more founders will start things and self-fund, and they won't hit the bootstrapping plateau that Eric mentioned earlier. So the question about Intuit, or what happens with existing software companies. So did any of you read the Citrini research report that came out a couple months ago? It was cataclysmic. It drove 200 billion of losses on NASDAQ. It basically said, Uber Eats is going away because I can vibe code Uber Eats in a weekend. Technically true, but you're not going to replace Uber Eats with a vibe-coded version of Uber Eats because Uber Eats is not the code. The code doesn't matter to Uber Eats. So a software company is much more than the code. Remember, Red Hat was bought by IBM for $30 billion. It was open source code. The code was free. So you have to think about what is a software company and what makes it durable. And in the case of Intuit, That is a very complicated deterministic system of record, and they've done a really good job introducing agents into what they do that I think will make it hard for somebody to say, I'm going to trust my, startup finances to something else. It's already cheap. They're already introducing all the agentic logic. They have been relatively well treated by public markets in terms of their revenue multiples. At least the last time I checked, that might have changed. Who knows? But there's a big debate about what's going to happen to software companies. And I think we're going to get to the zone of disillusionment a little sooner with AI than maybe some other transitions, because AI coding is changing the productivity of software development. It's opening up development to people that couldn't otherwise do it. It takes more than code to build a firm. I mean, if you look at what engineers do inside a software company, maybe it's 25, 30% engineering. If you look at the amount of time that they actually spend coding, it's a pretty small percent of their time. They're doing other stuff. Some of that will be impacted by AI too, but software companies are not valuable because of their code. And again, the production of code from the time of punch cards. I still remember my dad bringing back punch cards from programming, machines in assembly language, to COBOL and mainframes, high-level libraries, 4GLs, all this stuff. Software production has become 96% more efficient over the past 70 years. And it didn't just happen in the last year. It's been a constant improvement in the productivity of software developers. And through that whole period of time, demand for software has gone up, demand for software developers has gone up, and we've had multiple waves of people saying software is dead. Remember, we had no code 10 years ago. So I played around with this, like theoretically using Zapier and a bunch of other stuff. I could program and code whatever I wanted. It's still not my comparative advantage to be coding my own software. So we can have a long debate about what the future of software companies is, who's vulnerable. My belief is companies like Intuit are not asleep. They have access to the same tools that everybody else has. They're seeing the AI dividend. They have an enormous installed base. And most of their customers are going to rely on the intelligence embedded in QuickBooks by Intuit rather than anything else. And for a new startup to penetrate that market is going to be incredibly hard. I could be totally wrong. That's why this is so exciting. But and companies like Monday and Intercom, which are perceived to be very vulnerable to AI because they're sort of thin horizontal layers, they're not systems of record. Like QuickBooks and what Intuit builds, you would characterize as a system of record. The business runs on that. It's an audit trail, compliance-driven, deterministic system. But even companies like Monday and Intercom went all in on their agentic product. I can't remember the name, but it started at $4 million of revenue, and they basically just burned the ships. They just said, we're not doing that old thing anymore. We're doing 100% the new AI thing. We're not charging by seat anymore. We're charging by outcome. And that's grown from 4 million to 100 million in revenue in the course of, I think, 18 or 24 months. So some companies are more vulnerable than others, but nobody's sitting still. We did, one more note, we did as part of our thesis on AI, we went back and we looked at past technology transitions. And you remember we went from mainframes to PCs. That killed like 70% of the incumbents that were out there. DEC, Wang, all these companies died. Then we went from PC to cloud, and half the companies survived. We went from cloud to mobile, and like 75% of the incumbents survived. So each of these transitions, we've seen higher and higher incumbent survival rates, either because they've learned the lessons of the past or the transitions weren't as extreme as the ones before. But my expectation is we'll see an even higher incumbent survival rate moving into the AI era. Maybe.
I think it goes back to also the AI knowledge, right? Anyone who tries to compete, if we take it back to just the tax preparation, sure. If you have simple taxes, 1099, great. But the moment you have a mistake and it tries to handle the exception, it's kind of a nightmare until it learns and figures out the exception. And when you're doing your taxes, like all of us at the 15th at 10 p.m., you can't handle that exception. You don't have time to figure it all out. So my point is that the incumbents have time, because they've already dealt with a lot of those exceptions, and it's that leapfrog moat they have to build, staying ahead. Okay, so your world has changed a lot in terms of, it's interesting, if we did this even 2 years ago.
We did this 2 months ago.
2 months ago? Yeah, and I said, what kind of company are you looking for? What should the entrepreneurs be prepared for you? How do you answer that today?
Totally different. So some of you raised your hands that you want to go raise money from outside investors, potentially, maybe. Yes? So, I'm the next step. So we're early growth stage companies investing 4 to 5, investing at companies with several $1 million of revenue. But historically, to go to an institutional fund, you needed a product and you needed a little bit of revenue traction. And you would initially go to seed and angel investors when you just had a business plan, just a pitch and an idea. And I talked to an old founder that I knew from San Diego from 20 years ago, and he was pitching a new idea. And he had nothing to show. And I don't think that works anymore. Yeah. Like, I think you need to, before my guess, and I'm speculating because this is not my market, but I would expect any founders to have built what they're raising money to do and to actually have it in market, because you can do it. And you don't need, there's a lot of talk about when are we going to get the first 10 employee unicorn. And companies have been getting close, but you can build a product today on your own with a couple people and get it in market and get some proof points. And you couldn't do that, 20 years ago when I started, to build a minimum viable product of an enterprise software solution took $20 million. Literally, it was $20 million to build an MVP, not only because it took so long to code, but you had to stand up servers in a co-location center or at your office. Like, you had to buy servers to do that. And it took $20 million to build a version 1.0 enterprise software. It's completely different today. And I think if you don't have that, I would expect that investors will not pay attention to you because you've sort of failed the first step. Like, founders should be hustlers, they should be scrappy, they should be doing a lot with a little, they should believe in this enough to have invested a lot of their own personal time, maybe some of their own money to do this, to have recruited a little bit of a core team around them to build it. So my guess is the bar of what it takes to attract capital from a fund that invests in seed stage companies is much higher than it was before. But your ability to hit that bar is dramatically easier if you do it right.
So I'd say this is true for software companies. And if you're an entrepreneur right now who's, doesn't have any revenue, as you think about it for yourself, it's like, okay, how dedicated am I? Are you, you can, but are you dedicated enough to work on this, all nights and all weekends and get it, I would say then get advisors, perhaps, folks that will work closely with you to help you figure out how to get out to the customers, because you have to have something in some customers. Now, if you're doing something that's more hardware integrated, where there's a lot of software on hardware now, you're going to need some money to build out that hardware. So I think there, again, it's finding people that, what I've always described is when you're looking for money, the challenge with it is that it takes time. And your most valuable asset is your time. You could build that software in the software model, or you can go try to find money. So when you go to look for money, there are two groups of people to talk to, and the rest, I would argue, you don't bother. The first group is those people who know you already, the friends and family, because they know that you will execute and you don't have to explain who you are. The second group is people in the industry. If you're going into this, you should know who they are, easy to find on LinkedIn and through blogs and such, and they're promoting themselves. Because if they understand the industry, you don't have to explain what you're doing in the industry, and they will see that this is a leapfrog of some functionality or some solution that you're making. Outside of that, which is probably 99% of the I won't say investors, it's just the list that I see early stage entrepreneurs coming to me with it's a bogus list, and it's a bunch of people that'll have coffee with you. They mean well. They're very interested in what you're talking about, but no one likes to say no, so it's a waste of your time. So you have to be very just scrupulous with your time. So on the that's just as you go investing. If you've got hardware and software together, you've got to figure out who knows the industry, and that's probably the best way to find an investor there.
You brought up a really good meta point, I think. So if you're one thing, if you're raising money, the mindset you have to put yourself in is you're not asking the investor to make a rational decision, right? Most startups fail if they were making a rational, weighted returns probability estimate on the decision to invest or not. The answer is no. So the sale is persuasion, and it's emotional, and it's sort of the core lizard brain that controls our decision making that you have to appeal to. So things like, for example, did this founder get money from his or her family before he or she asked me for money? That's a signal, right? Did they quit their job and go all in on this? That's a signal. Were they able to recruit somebody that I recognize as smarter than me to join them? That's a signal. So it is an irrational decision, and you have to be able to put yourself in the mindset of being a master persuader to get to yes. And it's not the market TAM is big and we're going to sell for this. There's thousands of good stories like that. It's a persuasion exercise that is less rational than emotional. Because a rational decision is no.
From your perspective of asset allocator, may I get your take on tokenization? Since now that beside agentic engineering, everything's the next frontier with the clearer regulatory frameworks and your defensive against AI, would you be more incentivized to tokenize your asset or less incentivized? Would love to get your thoughts on it.
So the question was about tokenization, and I have no idea. I mean, so we're simple, and the only thing I would say that I can tell is we do have an administration now with advisors that appear intent on at least clarifying the rules with regard to crypto, and I would imagine that might affect things like tokenization as well. So maybe we're on a better path to the rules of the road being well defined, but we've never thought about anything like that.
So with a regulatory head in mind, I guess I would say on one side, it kind of depends. Is it a tokenization market where kind of I want to make sure that you can get the money and you can keep the money. I don't want it to be like a SPAC where it's like, hey, we got this money, and then 2 years later, no, we didn't. And then it's all changing right now, so it's a little bit difficult to answer in that if I have companies that have tokens or crypto, this is me speaking as a bank. The challenge is I am regulatorily required to know where the money came from and where it could go. That's for anti-money laundering. So the rule's called KYC, know your customer. So if you've got tokens, it's okay, but when you issued them, who did you issue them to? Can they sell them? Is it a marketplace? And I think that will mature, and we have even the big brokerage firms are starting to do that kind of thing. So that's okay, but I have to follow that chain down to the natural person. So even if you sold it to a company, I have to know who owns that company. So again, things can change, and this may all become easier. And if you're not going to a bank, okay, that seems possible but complicated, right? Know your agent. Wow. I don't think we do. I say think because we may. We're it's the cobbler's shoes, perhaps, but.
The reason why I ask because in a lot of monarchy jurisdictions outside of America, it's very hard to move money outside of their country. That's the reason why a lot of family office in the Middle East and Asia Pacific really interested in.
Oh, that's why you're asking that question.
Of course.
Okay. Yeah.
Yeah, I can't tell you how many companies I have that have interested investors from a country that does not want to let the money come out.
I would say now that I understand your question better, getting to Eric's point, even for us, the KYC rules are so intense, we would be very wary of doing anything that's skirted even on the edges of, in any gray area. So until those rules are clear, the last thing we want is the SEC calling us for something.
Because
They're still learning. I think they're getting it settled and figured out. But
yeah, it's interesting. There's a company I was talking to that they are now pulling together the data from various blockchains, because one of the challenges when you have to do an audit is that there's all these different platforms, and they've made some headway, and it's pretty exciting because they are now the source for companies like an EY to be able to conduct an audit. Now, you may not know everything. They may not. The problem is they still don't know who the person is, but you can see where the flows are going, or you can validate if they were to allow you to see who it was. So yeah, it's gonna come because it's easy and people like it.
we have a question here.
Yeah, I wanted to know because during this talk, you're talking how AI is changing fast. And
Yeah.
everything is changing fast. How much of that is going to be lasting change, and how much of that do you think is like sometimes just noise?
So the question is, how much of the AI hype right now is lasting change or noise? It's a good question. I think there is a lot of AI theater with a lot of companies sort of claiming that they're AI first with, bolting on a chatbot to their product. That's not AI transformation. But I mean, my view is this is a significant, enduring change to the way that companies run themselves, to what products do, to the way software is bought and sold. I think we've gotten a little ahead of ourselves in the expectations around how fast it's going to penetrate. There's going to be a lot of friction, I think, to embedding AI. That's why, if you've heard of I mentioned the hype cycle and going into the trough of disillusionment. It's a famous Gartner curve where you get a hype cycle and then there's a trough of disillusionment where it doesn't work the way people thought, and then you sort of, I forget what they call the slope of whatever, but I think this will follow the hype cycle where we're on this great hype cycle right now, and I think it is unlikely to achieve change as fast as people mostly fear, but the change that it has on everything that I do is going to be more impactful than any of the things that we've seen in the past. Just based on what I see it doing to the unit economics of running a software company. Enormous efficiency gains in running a software business. It's insane what companies can do now with 30%. I mean, we have a local company was on the board here, has 17% fewer engineers than they had a year ago, and they're doing 6x the code commits. So the product velocity is just going through the roof. Customer support, everything else. So huge impact. Product-wise, the transformations that our portfolio companies are making to what their software platforms fundamentally do, it's remarkable. I mean, they are changing their entire value proposition from buy a seat of software, buy access to our software, and we'll give you some advice about what to do. They're changing that to, what's your business problem? Yeah, I'll do it for you. I don't care, everybody can access, but I'm going to do it for you. And that kind of change is remarkable. And you combine with that the impact on physical AI and robotics. We haven't talked about the humanoid robots and what's coming. I mean, that's so sort of futuristic, but if you believe what's coming there, and software is going to power and run all that, we're in a world where, if you believe the Elons, we're in a world of just massive prosperity and abundance driven by robotics and software. And it's all intelligence that's driving that. What's happening is fundamentally different. If you look at the addressable market expansion of what software companies now compete for the $400 or $500 billion IT spend in the US. With what I described software companies being able to do, they're all of a sudden competing against the $6 trillion of knowledge worker labor spend. So the TAM is exploding. And all this, I think, is more enduring than not, even though there's going to be some flameouts, a lot of, the press likes stories of failure. So there's going to be some high-profile failure. It's going to drive, there's going to be all kinds of ups and downs, but it's real. I mean, we just see it every day.
I'd add to that on the signaling side. Today you can get away with not using a lot of AI. Today you can, but you can't in 6 months. Yeah. Like people, I mean, I know a VC who's using it to do his emails in the morning.
I look at my own business, and AI is completely transforming our business. And the way you should think about, Mark Andreessen has the best way of thinking about this. A lot of you are undergrads thinking about what's going to happen to, what's the job market going to look like in the future. I think the best advice and I don't know, best advice I've heard is just be the most AI first person you can possibly be, bring all those tools. But Mark Andreessen's view on the impact on jobs is that you shouldn't think about the impact on jobs. You should think about the impact on tasks. Most jobs have a higher purpose. AI can automate a lot of the tasks, can ladder up what it means to do the job that you're doing. And radiology is a good example of this. AI does a great job reading scans, does better than radiologists do. So what should happen to radiologists? They should go away. We don't need radiologists anymore. That's not what the data says. Salaries for radiologists are up. They're spending less time doing the low-value part of what they're doing, reading scans, and spending more time talking to patients, spending more time counseling, getting more done. So think about it as impacting what happens with tasks and automating tasks, not what's happening to jobs.
That's an excellent example. On the life sciences side, if we take just a small pivot in terms of raising money on the life sciences side, is there anyone here, before I go into this, we talked about life sciences, but in the diagnostic or therapeutic space? Okay, great. So the advice I would offer there is, the challenge is science is a wonderful thing. It's a hypothesis that we believe is true until we prove it's wrong later and learn a new hypothesis. The great thing about being in the life sciences side is that the addressable market is there's no question. We all want oncology. We all want cancer cured. We want diabetes cured. The question becomes, are you and your team the ones, and is the science that you're using, is that going to be the cure? So how does an investor then know how do you get their attention? And so what we see, for example, as a bank, when we get into those and they get investment, we look at putting the debt in the company. We're savvy because we talk to a lot of life science folks, but we are not scientists ourselves. Some of us are, but not all of us. And when we go to credit, my credit officer is not a PhD. But what we look at is, who is the chief scientific officer? What is the background of that person? What has she done? What companies has she been involved in? Who is the team that's involved? It can be a little bit tougher when it's first coming out of universities, but in that case, it's the signaling. Who have they pulled in as their advisors? Eric Topol's a famous local here that, who was involved in some of the companies that helped Illumina grow. Who did you get involved with, and who did you bring in to show that your science has legitimacy? So I'd offer that. Go ahead. It is interesting, but the challenge is, how do I believe you? I'm just being straight up. And so, okay, well, you can show me the classic, fluorescent mice is the joke that people make. But how do we, even if you have that data, and I imagine the process, right? We have clinical trials because that's going through the levels to show the toxicity, the efficacy, and then the dosage. And that costs a lot of money to get to those stages. So how do I get enough money to even do the first stage? Because you're right, it's binary. And it's interesting, the banks are very careful about how they loan. You will see that you cannot really borrow the money until you get the results of the first clinical trial. So stepping back from that, because we have to get the venture funding to get you to the stage that you can get the interest, to get around and get the debt. In my experience, it really is bringing other experts around you who have a longer history that the folks can say, okay, I believe them, unless we haven't met, so you may well have that history, if you've done one of these deals before. But if it's a first time coming out of university, I think going back to the story that you're talking about is, sure, you're passionate about it because you're the Kool-Aid drinking entrepreneur. I need someone who can be the third party that can help validate the data, make sure that we have good data, that was collected in the correct way. I think it's really building up a network of people who are influential in that industry of whichever area you're going after. And if they're believing it and throwing their name behind it, then that signals that, yeah, we should take a look at that. That's hard. We'll come back. Yeah, we have one over here. Yeah.
Yes, that's yours. I mean, we don't really touch on those kinds of things. I mean, the famous story is, Uber and Travis Kalanick just doing it, right?
Yeah.
That's not our. We're building enterprise software companies. It's legal to, so it's not our world.
The question was, as you the sentiment is that in the Bay Area, entrepreneurs develop and say, hey, I'm going to go and just do this regardless of regulation, and then ask for forgiveness later. I would say that that's a great question for all of you, because you're going to design the next level of companies and you'll figure it out. So yes, per Uber, you can do that. I think also, like, it used to be that software was first making money in stock, sports, and sex. The challenge is, if you went into the sex industry, nobody wants to touch that. And so if you're going to break a rule as to the transportation rules of a city, it's like, okay, they're going to bring us in, slap our hand, how much fine do we have to pay? That's not something that culturally is as bad as, wow, you're if we go back to the banking, even money laundering, I mean, Bitcoin, you can do that today, right? Like, it's and people are flooding towards it. So I guess it would depend what the regulation is that you're breaking. If, on the life sciences side, certainly don't want to be pumping people full of anything that hasn't been FDA approved. Though on the wellness side, we don't make full FDA claims. We say, this may make you feel better. I'm being a little facetious. It's a little, but some of those products may well make people feel better, and maybe that's good for the market. Some of them maybe don't have and this is what you have to be careful of, is like, how do you show the purity in what you're doing so that people will trust the brand and buy your product? Yeah. Well, and there's some industries like the CBD THC is really pushing the regulation, and it's changing, and still super difficult. If you ever notice, if you've ever gone to buy medical or recreational THC, is the one? Yeah, I always forget which one. THC, you'll notice that it's an all-cash business. That's because unless it's one business in California or the states that allow it, and you don't have money going outside, they because of the money transfer rules, you can't use a credit card because the credit card company is national, so they're afraid of the national government coming after them. You can't use a big bank. Like we're starting to work with businesses there, so it's super interesting because we are a national bank, but even then we're like everyone's starting to touch it, so it's an acceptable regulation break as opposed to one that is not.
So the question is, how does I mentioned physical AI earlier, and that we're starting to make investments there. How does that change the way we look at things? How do we think about supply chain resiliency? How does it jive with a software business model? So it is an issue. Like the company I mentioned, Orca, that does the camera pods on ships, they're in Israel, and their business was significantly disrupted by global events. So it is an issue. I would say most of the physical AI companies we're looking at look like software companies in terms of their recurring revenue profile and their margin profile. So they tend to just sort of capitalize the cost of the hardware over the course of a long contract. And so it looks very software-like, but definitely an issue. I mean, especially if it's something that relies on, I mean, TSMC is not building chips for anybody, Apple and NVIDIA. It's a challenge. Mostly, though, the hardware component is small. The unit volumes are small. That it hasn't been a concern in our underwriting. We have another one called Slingshot Aerospace that has a network of a global network of optical sensors mapping satellites. So they have a dozen all over the planet. Maybe they'll have 20. Maybe they'll launch a satellite on their own. But it's sort of a constrained, they're not doing humanoid robots, for example. They're doing things where their solution is enabled by hardware and also AI. So part of the argument for the super cycle in software is that the surface area that software can touch is moving from just knowledge workers to a lot of other kinds of workers. And our third physical AI software company is something that puts backpacks on utility workers and does things that couldn't be done before AI to transform what was historically just a physical job into something that's been AI enabled.
Yeah. Good.
I got a question, like from a VC perspective, do you guys care more about what real problem this company can solve, or you care about like how fancy or what's the how the new technology this company has? Like for example, I know Asian is really popular right now, but for a problem of those Asian companies is the agent actually can solve some real problem.
Yeah.
Like for example, open cloud, it was so popular, but open cloud can solve anything.
Yeah.
It's like just a tool for you, but it was so popular. So do you guys care more about the realistic problem the company can solve, or is like fancy technologies?
So much more for me the former. So when I meet a founder, what I mostly want to know, what I ask first. So typically a first meeting for me is 20 or 30 minutes. And I want to know two things. I want to know sort of the origin story. Why is this founder doing this? How did he or she decide that this was what they wanted to dedicate the next 10 years of their life to? That's very telling. And the second thing that I want to understand very specifically is, tell me about a typical customer. And tell me about a day in their life and what problems they have and what you're solving. So 100% of the way that I look at things initially, before getting into the solution, anything else, is understanding the founder market fit. Like, why is this? The best story is, I used to run a company that did this, and I looked for a software solution that could solve my problem, and none existed, so I started a business. Like, perfect. Some rationale for why that founder is starting that business. But then secondly, I want to know the problem that's being solved, not only because I want to evaluate whether it's an important enough problem, because selling a new piece of software to anybody is hard, so it's got to be a significant enough problem. And I want to know that that founder has really unique domain expertise and understanding of the customer problem that they're solving. Because I think, as Eric pointed out, earlier, you just have to be hyper-focused on one segment of customers and make their lives better. And I don't care about, the solutions. Software is easy to build, so it's really the unique perspective into a problem and solution that's differentiating founders. Having a cool solution is cool too, but my initial take is founder market fit and understanding of a customer problem.
So if I break that into a quantifiable, what we're going to be looking at is, what's your growth rate? So the cool features that got the customers that they like. What's your churn? So that kind of talks to, is it cool and is it staying cool? Does it do what the client? I don't know. cool is not a great definition, but are the clients liking it and staying using the product, right? So if you have, I want to see a churn of monthly less than 5%, and I'd like to see a growth rate, and then just from a business perspective, looking at, are you growing at a rate that is faster than the amount you're spending to grow? So your operations, because you can spend a lot of money to grow, and a lot of companies did that before, and there was fake software where they hired a bunch of people somewhere where it was a low cost of business, and the software really ran on people as opposed to software. But I would say the growth rate of your customer base and churn are two pretty important things that if you've got those great numbers, the business speaks for itself.
I'll just say one more on that. It looks like I have a follow-up. Be Steve Jobs, when you're pitching. And back to my point about persuasion, you're telling a story. You're telling a story. It is not a rational decision that says, oh my God, this technical architecture is clearly twice as good as what somebody else came up with. You're telling a story, and part of that is your story. Part of that is the customer's story, and you have to weave it together in a way that's compelling. So again, the mindset, the rational stuff has to be there too. Nobody wants to invest in something with no market. So there's table stakes. But the winning pitches are ones that tell a story and are persuasive in a way that's emotional and not rational. So you have to think of your story more than any one pitch, and think of the story arc, and think about how you build conviction and how you tell the story, how you tee it up, and how you say the things that the founder or the investor is going to be listening for, if only subconsciously. Little signs of validation, little proof points, little things that lead to a positive decision.
I've got demand that I can't meet because I don't have enough salespeople, or I can't produce this fast enough. We've got a company, and it's difficult. He's telling me, we've got demand that will buy everything it produces, a product that we produce through 2027. And for me as a bank, it's terrible because I don't look forward. I look backwards. I look at what you did, and your investors will look forward. But month after month, we see the production coming off and gone, and we see the pipeline. But sales guys, you can't trust them. You got to knock it down to 30% of what they said. But telling the story, yeah, that's a great story. Look at all these people I have lined up who want my product, and we can't meet the demand. It's just so hot. And again, I'll look back and see what your growth rate is. But tying that in, I think, is a positive part of that story.
I just realized something I'm going to do. I'm going to go build a persuasion skill. I'm serious. And I'm going to give it access to all the best books. There's books on how Steve Jobs presents. There's books on all this stuff. I'm going to build my own persuasion skill so that when I'm building documents and decks in Claude, I'm going to have it access that skill. You should do that too. That's a really good idea. Build a persuasion skill in Claude.
I'm reading some sales book about teach you how to be a good sales right now. As a startup founder, do you think the sales skill is the most important skill for startup founder?
You have to know how to sell, and you have to like selling, because you will never not be selling. Investors, customers, employees, and it is a learnable skill. I never had to sell until I started my own firm, but it is all about hustle and selling. Not all founders are, different founders have different strengths. There's product-oriented founders and sales-oriented founders. We have a highly technical founder now, and every call I have with him is, you're not selling. You're an engineer, and you're presenting like an engineer, but you have to put yourself in a different frame because your audience is not engineers, and they're not responding in the way that your team is going to respond to an engineering presentation. You can't do it. You have to expand your skill set and understand what it takes to sell and to close, and again, to persuade.
But what if all the buyer decisions be made by agents?
Well, that's the thing. Yeah. So if you believe in a world, but you will still have to, you'll probably still have to recruit employees. My job is changing a lot, but Claude is getting pretty good at predicting whether I like something or not, but my judgment is still there. Maybe customers will let agents loose to buy less important things, but probably not a 7-figure annual enterprise deal. So I think the human, and my view is human interactions, authentic human interactions and authentic human produced stuff is going to become more valuable because it's going to be more rare. I can already tell, you can tell if an AI wrote something, although my personal voice skill sounds a lot like me. I don't think anybody can tell anymore.
Is there anything you can share that how to sharpen your creativity skills, Brian?
You know, so I'm redoing our own fundraising deck. So we're a startup like you. We're just a different kind of startup. So we raised a seed round, a small $70 million fund from friends and family, rich friends and family, raised a $150 million Series A basically fund from some institutional investors, and we're going to go more institutional. And I just try to clean sheet every once in a while. And in this case, I did use Claude as a co-pilot on this. And the same thing I suggested I'm going to do on the persuasion, I fed it so much stuff. I fed it everything I could find. I fed it all competitor decks. I fed it our manifesto, all our materials, and I started playing around with different stories. And I just used that as a test case. And you never know until you're out in the wild giving the pitch. What resonates, what doesn't. I'm always surprised by what resonates with folks, and then you amplify that.
So you make time for it, and nothing's sacred. You got to be willing to let go of your prior baby. One thing on the presentation too, when we were talking about the story, if you're on the software side, and I think this applies on the science too, is my advice would be careful about the features. Like, never take me through your software and show me, oh, this is how you log in and this is what this does, because I don't care. Your customers will tell you whether it works or not and whether that's important. So it's more talking about why is it important to your customer, or why is it 10% better efficacy, but how you get there, at least on the tech side, it doesn't matter. And some technical founders can treat it like, oh, this is my baby and look at this great UI.
Also, so from ours, you're a banker. So as an investor, a product demo is really important for us. So we spend a lot of time going through the product demo, and we're looking, again, not just to see what it does, but we're looking at the care that the development team put into the product. Is it pixel perfect? Like, it's not, that doesn't really make a difference, but it's a sign of care that they built it this way. Does the UX make sense? How deep is the product? We can get a sense for how important is the software based on the depth in the demo. So we do spend a lot of time in the demo looking for both evidence that it is a complicated solution and a well thought out solution, but also just the care that the team put into the UI UX, because you can tell a lot about the culture of the company.
How deep in the diligence? But like the first meeting.
Oh, we want to do that. No, so we typically do a 20-30 minute call, then a deeper 60-minute call with a broader team, and then the full partner meeting is 90 minutes and includes a 20-30 minute product demo, third meeting.
Fair enough. Is there
That's a good question, and nobody really knows about this. All this stuff is hypothetical, and all this is changing so fast. Like, it was just Q1 that everybody had the aha moment about what Claude Code could do, and where the pace of change and these new models coming out were just so different. So we're like 2 quarters in to a broad enough set of people understanding what this means, and broad enough probably means 5 or 10% of the population. So we're really early. So we don't know. Human authenticity would seem to be something that would be important moving forward. So the way that AI is changing my job is allowing me to spend more time doing the human-to-human stuff. It's changing a lot of the crap tasks that I hate doing and automating that, and letting me spend more time doing human-to-human stuff. But I don't know. I mean, orchestrating things. The theory is, if you want to believe the positive, the negative story is, you know, Dario from Anthropics take that 50% of all knowledge workers are going to be fired in 5 years. You know, that's one take. The other take, more the Mark Andreessen, Jensen Huang take, is all of a sudden everything that people hated doing is going to go away, and every job ladders up because the job is more than the sum of the tasks. Most jobs have a purpose, and AI lets you do less of the tasks to focus more on the purpose. If your job is answering customer service calls all day, you're basically doing all tasks and you're probably in trouble. But most jobs in the US that you're going to be graduating into or that you're going to be doing, they're not task jobs. They have a higher purpose. So you should think about AI as letting you focus more on the parts of the job that matter and taking away the tasks that don't.
So from a company perspective, the danger is, for example, a bank. I'm at risk of losing my job because our data is so sensitive, we're going to be a slow adopter of AI. So the tasks that I have to do that are not hugely generative of revenue for the bank are not AI solved yet. And I have competitors that are new on the market who, the neobanks, they're not really banks. They're borrowing the bank tools in the back from other banks. And they're coming up and perhaps they're using AI, so they could be faster. So it's a real risk. You know, I think of call centers then, where I used to run a 100-person call center, and like if you think of your cable company, the person that you call that's going to help you fix access to the cable and your internet issues in your house, that's going to be automated. But the most valuable persons in that call center are the ones when you want to cancel the service and they throw you over to the retention team, right? I think that'd be harder to make an agent that does that, that saves you, right? Because they have to show empathy, and eventually, I guess, yeah, it will. I mean, as it learns, it will.
But nobody really knows. The conventional wisdom is, boy, if you're in school, don't become a software developer, right? Software development, it's going away. Why would you do that, right? But have you seen what's happening to job postings on Indeed for software developers? Overall, job postings on Indeed are like that. Software developer postings are like that. And again, it comes back to Jevons paradox, and the founder of Claude Code was ripped on X because this is the company making the tool that's going to replace developers, and he's got open recs for 130 software developers. And the founder of Claude Code said, somebody still needs to run the Claude, somebody still needs to work with the product team, somebody still needs to do all this. The job of the engineer is changing, but the demand for great engineers and developers is as great as ever. So nobody really knows. You've got this doomsday scenario, and you've got a different scenario. I'm a little bit more maybe optimistic in nature, but I also see in the data, people are hiring a lot of software engineers. Back to Jevons paradox, a software engineer can produce 5x what they could have a year ago. So if somebody's 5x is productive, you would expect demand for that resource to go up. Back to Jevons paradox.
That's a hard, so I'll start with this. We have the resources in San Diego for either maybe money, but also connections that can help you because it's all networking, right? You've got connect.org that has both tech and life science entrepreneurs, and they create access to those entrepreneurs. You've got J&J's J Labs, right? Not necessarily medical device, but it sort of depends because how big of a medical device is it? Is it like medical device can be a small thing or a big machine? But I think it comes back to what I said earlier is you know, you've got to get them. If you have to do 10 of them, if you have to do 100 of them, you have to get them 1,000. You have to get the money to do that. But my question is, do you? Or do you find the person who's in that industry? Because I don't imagine this is a new industry. You're doing something better. So who are the people that know that industry and can show that what you're doing is better? And as to when you need money before you run out. I mean, I don't mean to be sassy on that, but you always need money. So I would encourage you to look for the people who matter in the industry that relates to your medical device and figure out how to tell the story to them, maybe not necessarily for money right away, but to talk to them about advice. Because, you know, the old rule is if you ask for advice, you get money. If you ask for money, you get advice. And the people that, if you ask them for money, they never want to say no. Whereas if it's advice, then you open the door and say, look, this is what we're doing. And the humble, you know, where are we missing something? Oh, and can you tell me someone who knows about that? And it takes time, but I think through that, you will either find that you're on a false errand, or you'll find that, yes, we actually do have something, and there are people that start to believe in it. And people are smart. If it's really, really good, they're going to want to invest if they have the ability. I mean, not all of our friends scientists have made it yet to have money to invest. But you can, again, you're getting someone who has some credibility to validate what you're going after.
Yeah, I think just one thing I want to echo on that. You shouldn't think of fundraising as a discrete thing. Like, you will have to put some time and consideration into when you launch a formal raise and you really do it. But fundraising is just something you're always doing. It's a core part, meeting investors, thinking about where you're practicing your pitch. You know, we're not fundraising now, but I'm always fundraising. Like, I'm always meeting potential investors, telling our story. It's something that's just, it's 5% of what I do this week. When we're really fundraising, it'll move to 30 or 40%, but it's always a part of what we're doing. Qualifying investors, you know, writing off the ones that are unlikely to be good fits, just building that target list, telling the story. It's something that you will be doing all the time, forever.
Who are the university professors that maybe know your space, right? That know the research in that space, and it's a couple steps. But then you ask them the same question, and find someone who's maybe been successful in that space. You know, San Diego has ResMed, really great company, and there's lots of employees there, and the family has matriculated down the CEO. But those people are in town are accessible. You just have to find them and figure out the way to get to them.
So when you come into my house through the garage door, there's a wall, and I put one of these sticker things up there. It says, "Every day I'm hustling." Yeah. And that's just to remind my kids, to remind me, every day I'm hustling.
Yes.
I'll start with analogy. When you find anomalies in the market, it works at a smaller scale, or if you take out the cost of transaction, it works. If we think about it in starting a company, and if we get the niche market to work, and how do we go from there? If we scale it from there, or do we just call it a day and sell the company?
And that's a good question. So I will say, I don't know, but so the question is, how do you know if you're starting off targeting a niche and you have success there? How do you know when it's time to expand to adjacent markets or just stay in your core market? I don't know enough about what you're doing or the logic of moving to adjacent markets, but I will say, I think companies that are hyper-focused on very specific niches early have a higher likelihood of success. And so we typically want companies that we're investing in to not try to do too much, to stay focused. Depending on the size of that market, we may want to know that they've got a logical extension. And the logical extensions we like better are product expansions to the existing customers. You can think of a 2x2, product and customer. Same customer, same product, different product. You can take your current product to a different customer, or you can take new products to your same customers, or new product to new customers. That's obviously the least likely to succeed. We generally like staying with the same customer and finding more that you can do to expand the product in that existing customer.
I'll tell you, your customers will answer that question for you. if you've got a lot of speed within those customers, you're going to not want to sell, right? Because you've got a good story of why should it? Because it comes down to if someone was going to buy you, what would they offer? And do you think it's worth more? Well, it's worth more because we've got this growth rate. Along with what Brian's saying, one of the conundrums you have with a new company, and we had this in the company I worked with, is early on, it was a CRM software back in 2000. So we were competing with Salesforce.com, but they were just coming out, so we were still kind of nimble. But we had to figure out which industry. We're going to go in the telephone industry, the telecommunications, mobile phones, or high net worth financial, or just helping out call centers. So there were basically 5 industries we had to figure out. And we had to figure out to put it, and the bummer is now I'm spending 5 times as much money, right? That's why I want to go to one, but I got to figure out which one. So we tried to be diligent in, as soon as we found momentum with one of these customers, we killed 3 of them. We went down to 2. And the 2 ended up being the telecommunications, partially because we got lucky. There was this space where when you had a cell phone, you didn't used to be able to switch it over to a different carrier very easily. And so the government mandated that you had to be able to switch carriers. And we built that knowledge base out in a week and sold it all over. Short-lived, but we got into the big telecoms. And we saw that we made money there. We went into the wealth management, and we made money there. The interesting thing, though, was as we went up that chain, we saw, oh, this is for a high-touch, high-value customer. So then we could look across industries and find out who else has a high-touch, high-value customer, and then expand that way. But I would say, yes, focus as early as you can, so you're spending all your money on one horse, because if you spend it on the 5, you don't make it, you're dead. If you spend it on the 1, you can go back and revisit the 5 and figure out if there's a match.
How do you start a venture fund?
Not yet, but we're planning.
No, but that's the question. How do you start a venture fund?
I got to throw in one question right away. Do you like to raise money?
Yes.
Because everyone likes the fun part of venture where you invest, but if you don't get there until you raise the money, so you got to like to raise money first.
Do you know a lot of rich people?
Some.
How many?
A couple. Maybe not enough, but.
I mean, the way to start a fund, it's extraordinarily hard, harder than raising money for a startup, because you're not pitching you're not pitching an opportunity. You're pitching you and your ability to pick good founders. So it sounds like you'll have some experience from UCSD, and the way that most younger people get into the business is by raising a small fund. Just raise a few $1 million. If your rich friends can stake you a few $1 million and put it into some good companies, and then go raise more. But it's a slow path, and you need to have to make a living doing this. You guys know how the business model works? How
you get paid?
You know how we get paid? Yeah. Well, so it's called the 2 and 20 model. If we have a $100 million fund, we collect 2% management fees typically every year. So that's $2 million. That pays salaries in the office and everything else. And then we get 20% of the profits. So if we turn 100 million into 200 million, inclusive of all the fees that have been paid and everything else, we get 20% of the 100 million profits. We get $20 million. Every penny has to be paid back to our investors before we see a penny of profit sharing. So the time it takes to get a carried interest check could be a decade from when you start.
10 years.
10 years. So if you're managing $3 million, that doesn't pay the bills on a 2% management fee. So it's very hard. You sort of have to, it's very hard to hustle, to get to the point where you can sustain yourself running that business. Meet more rich people.
Or really good entrepreneurs.
Yeah, a lot of our fund one came from successful software company founders that had just had exits. And also find a niche. So I think focused, and if you can build a brand for yourself in some area so that founders know you and you have expertise. So if I was starting fresh, I would be hyper-focused on something where I could become a thought leader, not just with my potential investors, but with founders. I get really smart on one thing, and develop a really focused thesis.
Perfect example right here. I'm a banker. He's a VC. He's the thought expert.
All right. Oh, one more.
Oh, you can't answer that. That's like asking who your favorite child is.
Oh boy.
It's tough because you have some of the winners, then you have some really interesting entrepreneurs. I know some of his portfolio, but
I'm not gonna answer that question. I'm trying to think of a question to jujitsu that into. That would be okay.
Like what quality of the startup founder that you guys pay attention or focus? Like you think it's worthy to invest?
That's a good one. So I'm gonna take that as your question.
what quality are you looking for in your startup entrepreneur?
So I love the hustlers, and a lot of the founders that we're backing are, some of them are sort of the second, third generation startup founders, but it's sort of the first generation ones that are just doing stupid things that shouldn't work, but are just so they're just pirates, and they're just willing to fight through everything to get things done, and they have an energy and belief that honestly just makes me jealous. Like, I wish I could be what that founder is, because they're just forces of nature. And I can think of a couple specific ones who I will not name that are just so remarkably good at what they do that it's sort of awe-inspiring. All the founders are unique, and they're all special, and they're all building something new. Anybody who builds something new from nothing has done something that 99% of people will never do and couldn't do. It's hard. So every founder is on an elevated plane from my point of view. I think of myself to some degree as a founder now because I quit my job and almost ran off a cliff getting Ankona off the ground, but not like what most of these people are doing. So the ones, I do have some that stand out, and it's for the just extreme hustle and drive where you just knew that they were going to succeed. And by the way, I have a famous, I almost told the story earlier. One of those people that I met was Travis from Uber. And I was so young and dumb at the time that I met him. This is before Uber. And I used my logic to decide that investing in his company was a bad idea. And so we didn't invest in his company. I should have recognized that he was a remarkable entrepreneur, one of these elite outliers that was going to do great things. And even if the thing that I killed didn't work, which it didn't, so I made the right decision, it was still the wrong decision because I never talked to him again. I never saw Uber. We would be having a different conversation maybe if I had made the right decision, which was the wrong decision back then, because I'd potentially been an investor in Uber.
Because it was logical, not emotional.
It was logical, and I did not. I was too inexperienced as an investor back then to recognize those traits that I'm describing as founders that will break through any wall to do great things. And he was that, even though the idea he was pursuing at the time wasn't one that worked out. And I was right about that. It's easy to be right saying no. The thing that differentiates the good investors from the bad investors are the ones that are willing to take a bet and say yes. It's easy to say no. You're right. If you just say no, you're right, 80% of the time. So the good investors are the ones that know when to make an irrational bet and are willing to say yes and to go to the mat and take risks to say yes.
It's interesting. I would have thrown in the word tenacity, but not coming back to me when I say no and trying to convince me another way for the money, but tenacity in terms of the product. So I'll talk about one of your babies because he's talked about it publicly. Ford Blakely did a company called Zingle because he was waiting in line for his coffee. got bored and thought, this is, I mean, today this is all done, but this was before you could order your coffee ahead of time. So we thought, well, gosh, wouldn't it be simple if I just had a simple little text that just bing, send to the back, and they have my coffee when I come up to the front. And then on the product side, he listened to his customers and found out, oh, this works for coffee, but without a lot more work, I can do this for the valet. And so he started growing the company and eventually sold the company to Medallia. But he was just tenacious and he's funny. And I also love it when they love the product and what they're doing so much. They deeply know the knowledge of it. They're the expert in it. And they don't bore you when they talk about it, even though that's all they talk about it, because they're so into it. You get sucked up in the religion. It's like it's tenacity. Great. Well, thank you all for your time. I hope you found it useful, and we'll see you again.